Good afternoon, everyone. Just before we begin, and as people are piling in here, I want to just do a quick audio and screen test here. Just let me know if you see my screen and hear my voice okay. Just wait for some responses. Good. Thanks, Francis and Siraj and Chris and Alan and Bill. Thank you very much, guys. All right. All right, so my name is Jeremy Tang. I'm one of the co-founders of Shark Indicators, the makers of a product called Bloodhound. A product that lets you build, backtest, and execute any trade system that you can dream up of. So many of our trade partners, many of our industry partners use our platform to create systems and whatnot that you can trade and as well as customize using Bloodhound. And so we go out there and we select a bunch of the top NinjaTrader partners. That's basically our goal here, is to give you a variety of different trading methods and personalities. And each one of these guys are successful in their own right, and they all offer unique trading styles. So the whole point is to help you find something that speaks to you in terms of trading style and personality. And so it's my pleasure today to introduce to you Daniel Rowe. He began his trading career in 2007 working for a private equity fund in Ecuador. And basically over the last nearly a decade here, almost coming up in a decade now, he spent pretty much all his time developing and testing trading systems. So he's got a tremendous amount of experience in that area. And in early 2013, as sort of a way to search for kind of a faster and better way to build out these systems, Daniel hooked up with us and found Bloodhound. And by the end of that year, he picked it up super fast. So I remember this. Daniel is one of the people I found could pick these things up faster than anyone else. And before long, he was actually offering Bloodhound programming services to create custom strategies for as a service. And it's basically through building all these strategies and countless amount of testing for various traders and for himself, Daniel's able to amalgamate all that experience and information and eventually come up with some very profitable and advantageous methods for trading. So without any further ado, I'm going to be passing the torch over to Daniel here, who's got some pretty cool stuff to show you today. Believe me, I've seen some of it. He sent me some screenshots, and I'm quite excited to see what he's got. So, Daniel, can you hear me okay?
Yeah, I hear you.
Okay, let me put the presenter over to you here, and then you can sort of take over here.
Perfect. All right. You hear me loud and clear? You see the screen?
Yeah, I see your screen and can hear you okay, and I'm just going to check here. It looks like people are responding with a yes here, so I think you're good to go.
Okay, perfect. Thank you, Jeremy. Always a pleasure working with Jeremy and the team at Shark Indicators. Like he said, I've been working with these guys for a number of years. It's been over 3 years now, I guess. And, you know, like he was saying, I've been building trading systems for Bloodhound users for a while. Actually, I stopped doing that when I started really focusing solely on developing something that I could use to actually trade with and make money with. So it took a number of years. I mean, I've been trading since 2007, and honestly, I was totally unprofitable for the first, I would say, about 6.5 years. And like Jeremy was alluding to, through testing with Bloodhound and building out all these different systems and testing all the different methods, I feel like I've found the most important methods in trading. Number one would be market geometry, and then confirming areas in market geometry across multiple time frames with advanced volume analysis. Something we use is called relative volume, and also momentum divergence. So what I'm going to show you today is kind of the end game with building out these different divergence solving algorithms that we've been working on for the past 3 years. And it's finally reached its culmination. So I began trying to build out something to find divergence pretty much immediately right when I got Bloodhound. You know, looking at momentum divergence, and we'll talk about it, we'll explain what it is, but looking at that and using it and seeing all of these major reversals occur when you have waning momentum into a major low or into a major high, seeing that over and over, you start to think, well, this has got to be a useful method, and then you try and test it programmatically, and you know, you never can get it just right. You find signals that shouldn't be found, you're missing other signals that should be, and it's just an incredibly difficult thing to program. So I tried to do it in Bloodhound. I did pretty well with it in Bloodhound, but it gets to be so many different conditions and so many caveats and filters you have to add in and all these little nuances to it that it becomes just basically just too massive of a Bloodhound template. So I wanted to take it and program it so that I could take that one solver in Bloodhound for the divergence analysis and then test that with every other system that I had created. So that's kind of the way it started. And then towards the end, like I said, I combined this with the market geometry and the relative volume and started trading that in sim for a year to prove that out. I used to show the sim results, but that's really not something I'm going to do anymore. For one thing, it can be a little bit misleading. You know, obviously, your results are always going to be a little bit better in sim than they will be with the real money. So as of November, so I ran that. Let me just kind of start over a little bit. Let's do this before I go on. I want you guys to understand that this is, without a doubt, the most difficult thing that you'll ever get into. It's incredibly difficult to make money trading. I'm sure most of you know that. But obviously, don't trade with money that you cannot afford to lose, because if you're trading with real money and you haven't proven your system, if you haven't, you know, at least vetted it in a sim account and grown a sim account, then chances are you're going to blow that entire account. Okay, so understand that. And then let's do this. These are the things that we're going to discuss today, and I was just talking about that track record that I had been kind of building in sim over a period of about a year. It went on for about a year and a half. I'll show that to you here in a moment. We've already kind of talked about who I am and my background. I'm not going to bore you with that, but what I do want to get into is focusing in today solely on the divergence algorithm, right? Because that is one of the key pieces to my method, to my trading methodology, and that's for confirming some of these major turning points in the market. And I think by the time we get done today, certainly by the time we get done on Saturday, you will see exactly how important this truly is. So divergence, I think, is one of those things that people just kind of they look at it. It's kind of the same way with a lot of different things. You read about something, you learn about it, you try to apply it, and then you have 2 or 3 really bad losing days in a row, and then you blame that on the method that you were just working with. The problem is people do that over and over and over, and they keep acquiring new indicators, new methods, and they never properly vet out anything. You know, this game has a lot to do with statistics and kind of lining up probabilities, and the way that you test something out is incredibly important. So you can't just, you know, try out a method for a few days. Oh, well, I lost money for 3 days. I'm going to give that up and go learn something else. I think that's something that happens a lot with divergence analysis. People just kind of, you know, write it off. So anyway, I want to fully explain what it is, why it's important, and then I'm going to go into kind of the development of this indicator. I'm not going to spend too much time on that. I just want you to understand just how incredible this coding really is. The main couple of signals that I use personally in confirming my entries, and oftentimes my exits, are these double and triple regular divergence signals. Those are quite interesting. I think you'll agree with me by the end of this. The main update, so we just had an update last month. Jeremy, I think maybe it's been 2 months, huh? But I think it was 2 months. So with that update, we really increased the efficiency of the algorithm. We made it so that we could find the setups in real time, actually, and then we created this reader indicator, which allowed us to access all the different signals from any time frame, from any market even, from absolutely any other chart in the NinjaTrader environment into Bloodhound without having to run those divergence calculations in Bloodhound. So we kind of bypassed the whole, Ninja 7 can kind of bottleneck sometimes and lock up, especially if you have too much stuff running. So we've kind of bypassed that with this reader indicator so that we can actually look at more markets, look at more time frames inside of Bloodhound without slowing anything down. Okay, and that's the reader. Okay, and that was the major update last time, as well as a number of other fixes and improvements. But in this 4.0 version, that's been amplified. The reader's definitely, quite a bit better, I would say. But the main thing that we've added is the ability to bring in any other instrument into Divergence Pro. Okay, so before you were kind of stuck with only being able to look at divergence between price and any other indicator. Right now, we can actually bring in any other instrument. So we can compare things like, the market internals for the S&P 500, for the NYSE, all of the uptick, downtick, the tick index, the advanced decline line, any sort of market internal index we can bring in. We can, look at Forex pairs with the same base, kind of compare relative strength, things like that. Sector analysis, we can look at different stocks compared to the ETF that they're in. So a number of different things we can do now with being able to bring in a secondary data series. So that's a pretty big improvement. I know a lot of people have been asking for that for a long time, and it was just an incredibly difficult thing to accomplish, but we finally have that done. So near the end, once I get through all of this, we're going to go into some examples of how I actually combine the divergence with some of my other tools. I'm not trying to confuse you with this, but I want you to get some sort of idea as to how I piece all of this together. So divergence is one part of the puzzle, and it's a very important part, but I want you to see when it comes together with everything else just how incredible that really is. And then in part 2 on Saturday at 4:15, I'll make sure you guys get that link before we sign off today. We're going to go through the past 10, 12 days, whatever, for each of these 3 markets. I don't know if we'll be able to do all 3. I at least want to do the ES and CL, just so that you can see, I'm not cherry picking, I'm not going to just kind of take anything out of context. I want you to see how this works in sort of a bar-by-bar fashion, day by day, looking at divergence across every time frame. And you'll see, all right, the main thing that I try to accomplish in my trading is I want to find those major turning points. I want to find the high of the day, the low of the day, the major swing low, major swing high of the day. Obviously it's not every day that you get one of those perfect swing points, but definitely a few times a week per market, you get some pretty obvious and major swing highs or lows. All right, so I've been in the business of trying to find why those swings occur the way that they do and where they do, and how I can anticipate those swings happening. And it's been through combining all of these methods, the divergence with the market geometry and the relative volume, across the multiple time frames that I've been able to nail this down, and it's pretty incredible. So I think you could safely, yeah, you could ask anybody in our trading room just how incredible it is to see these things happen day after day. So I'll make sure you get that link before we close down today, and now I want to jump right into it. Actually, before I do that, let me do this. So I was mentioning before, I'm sure if you guys have seen my presentations before, this is nothing new, but I'm kind of scatterbrained when it comes to presenting. My main focus is trading and developing the tools that I need to be able to trade effectively. And I make them available because it is incredibly expensive to have this stuff designed and built out. And, you know, my day-to-day is trading in the morning, running the trading room, making sure people understand how to use this, and try and find major turning points throughout the day, every day, and then in the afternoons develop and make these things better. So when it comes to presenting, that's not my strong suit. But what I want to do, let me just log out and log back in. So I was doing this track record, I think it was March 2015, March 1st, 2015. And I took a $10,000 account to just a ridiculous number. I'm not even going to talk about it because it was a sim account, and you know, that's kind of frowned upon to be talking about sim results or backtest results. These were not backtest results. These were trying to treat a sim account like a live account to vet this system properly. Because I've done it the other way. I've you know, taken a system and tried to make it work without properly proving it first with live money, and invariably you just watch that account dwindle more and more week by week. So I wanted to do it the proper way, and I did that, and it was incredible results. So I took I wanted to start with a very small live account, $5 grand, to show people that it is definitely very possible to grow a small account incrementally, day by day, week by week, until you get it big enough to where those percentage gains start meaning a larger and larger and larger dollar amount. So, you know, it's one thing to make nearly 200% in 2.5 months with a $5,000 account, but to make almost 200% in 2.5 months in a $100,000 or a $200,000 account, well, that's definitely saying something. You know? So here I am today at 14,166. That should be over 15 grand. Ended up taking a trade in sim when it was supposed to be in my live account. That's the second time I've done that. So I've got it rigged up now to where it, you know, it won't log me into sim automatically anymore. But anyway, I started with $5 grand in November, and I haven't been able to trade every day. I've been trying to get all these tools built out, run the trading room. So I'm not trading like I used to. I'm not able to dedicate as much time to it as I used to be able to. But nonetheless, with the time that I've had, you can see it growing. So it started at 5, up to 7,200, and then 11,500. I'm fine showing these results because they're real and they can be verified. So now we're at 14,166, up from 5. So that's just to show you that it is possible to take a small account and grow it using these methods. And the most important thing about this is the fact that my losing days are actually quite small. I think I had one that was $600 or $700 one day. Maybe it wasn't that much. Yeah, I lost about $400 and something one day. But that was about it. So it is definitely very possible to do this, and I just wanted you to see that, you know, just to kind of, I've been in the position where I was watching all these webinars and doing all this stuff, trying to get to the point to where I could save the accounts that I had blown and I know what that's like, and I know how that feels, and it's just an incredibly sickening feeling. I just, if any of you are out there going through that right now, just, it's difficult. I know it is. It's hard to get over, but if you spend the time learning the right methods and get away from this red light, green light stuff, then you can definitely have a chance at this. Not to say that the red light, green light stuff is useless, but there has to be some level of when to take it, when not to take it. Okay, you can mechanize things to an extent, but that's, I'm not all that interested in full mechanization. So I want to retain some level of discretion, so that I can deem when necessary to pull the trigger or not pull the trigger. Okay, so let's get into this. Bearish divergence. All right, we have regular divergence, and then we have hidden divergence. Regular divergence is looking at essentially waning momentum conditions. All right, so if this indicator on the bottom is momentum, it's something called balance momentum. It's similar to the standard momentum equation, but if we're above the zero line in the momentum and we start working back towards the zero line, that's decreasing momentum. If we're below the zero line and we start working back towards the zero line, that's decreasing momentum. So if we're going up and we're making new highs in price, but the oscillator is making a lower high, that is bearish regular divergence. I know for most of you this is pretty common sense type stuff, but this is probably a new kind of a method for some of you out there. So let's just kind of nail down the definitions. Bullish divergence. Bullish is obviously looking at lows in an attempt to forecast future higher prices. Bearish is looking at highs, trying to anticipate lower prices. Okay, so bullish regular divergence, looking at the two swing lows in price. We have a lower low in price, but a higher low in the oscillator. Okay, that's waning momentum into this secondary swing low right here. Okay, and the Divergence Pro will find these for you automatically. So hidden divergence is not looking for waning momentum, it's just looking for, it's kind of the reverse of regular divergence, which is why they call it reverse divergence or type 2 divergence. Again, for bearish, we're always looking at highs. Bullish, we're always looking at lows. Here, bearish, hidden divergence, we have a lower high in price, but the oscillator is making a higher high. So basically at the second high, the high in price, the oscillator will be more overbought at that secondary high. Let me turn on my little cursor so you can see my mouse a little better. And to be honest with you, I don't even remember how to do this. And let's see. Yeah, here we go. So at this secondary high, which is a lower high in price, we want to see that oscillator more overbought at that secondary high. So the oscillator will be making a higher high, and price will be making a lower high. So that's your typical bearish hidden divergence. Hidden divergence is typically with trend, but not always. If I were to be interested in trading hidden divergence, I would be looking for the with trend signals. Okay, hidden divergence is not something that I use that much because I'm not really looking for trend trades. I'm looking for those big reversals. They may be a trend trade on, say, the hourly chart or the 240-minute chart, but typically on the chart that I'm entering on the 2-minute or the 5-minute, it's going to be a counter trend trade. And on those faster time frames, I'm looking for the actual, waning momentum divergence, the regular divergence into that swing high or low. Okay, so these are multiple examples of hidden divergence. And now the opposite, the bullish hidden divergence. You see the with trend kind of scenarios. Basically, it's like the oscillator's resetting at that secondary swing low. So you want that low to be higher in price, and in the oscillator, lower. Okay, so everybody kind of have that down now, because now I want to show you how we have developed out the double regular divergence and the triple regular divergence. So this is probably the most important thing that I've added to this as far as I'm concerned. The double and the triple, well, next to the fact that we can now bring in the market internals for trading the ES. That's a pretty massive accomplishment too. But this double and triple divergence is really quite incredible. And I'm going to show you a few examples today, and you're going to see several dozen on Saturday. It's really quite incredible how this tends to confirm some of the major turning points throughout the day and the week, but on the faster charts. So on the faster tick charts, maybe the 2-minute or the 5-minute chart as well. So here, it's a regular divergence, but it's the second one, and you see prices making this a third low. So this low is lower than the first, right? That's the extreme in the oscillator. This is a MACD. And then the secondary low in price is lower than the first, but in the oscillator, in the MACD, it's higher. That's our first bullish divergence. And then our subsequent bullish divergence is even lower in price, but even higher in the MACD. Okay, so this is actually a pretty amazing signal here. And if we get 3 in a row, well then that's triple bullish divergence. Everybody understand that? So when they're really nice and kind of symmetrical like this, this is kind of a picturesque looking version of this. Quite often those end up being some major trend reversals, or at least a major swing high or swing low. All right, so that's the triple. And I also added in, well, I'm going to give you a couple of examples first, but I'll show you that next. So this is just the chart from today. This is the 233 tick chart. This is the last chart that I took a screenshot of before kind of finalizing all this. Just to give you an idea as to the triple divergence. That was the high yesterday in the 6E. This is a very small, fast chart. This is a 233 tick chart. Okay, at that high of the day, we put in a triple divergence. At the low this morning, before the secondary lower high, and then we came back down, at the low this morning, we had a triple divergence right there as well. And you see this one is actually quite pronounced. Momentum is completely sideways at that point. So price is just kind of chopping back and forth into that final low. And then again, at the swing high before coming back down, we have a double divergence. Okay? So that's just the most recent example from today that I could find, but you'll see when we go through on Saturday, this is a pretty common occurrence here. All right, this is the next major signal that we added. To be honest with you, I hadn't really heard anything about this. I've always been more focused on finding, waning momentum. I added the hidden divergence in because there's a lot of people that trade with that. There's a lot of people that teach it, and a lot of the guys had asked me to please do that, so I did. But then I started, looking at it and talking with another guy that had been pretty heavily involved in stuff like this. And he said, why don't you look at when there's a hidden divergence that fails and then turns into a bullish divergence signal. He was telling me, when those line up just right, kind of at what looks to be about the midpoint of a trend, they can be some pretty amazing signals. So I said, okay, well, I'll program that out. And this is the culmination of that. So this is one of the kind of picture-perfect looking signals. And here, obviously, you have a higher low, a higher low in price, but a lower low in momentum. So we came from extreme overbought at the high all the way down to extreme oversold, and then we turn up a little bit, but then it fails. And it fails on waning momentum. So we're coming down stronger here, and now we're coming down not quite as strong, just ticking out that low, stopping on a dime, and then turning back up. It's actually a nice little volume signal there as well. All right, so that's the next major type of signal that we've added. And if you'll notice, this balanced momentum here, obviously you don't get the same scaling in unbounded oscillators. I don't know if you guys are very familiar with the way that these oscillators are calculated or not, but the scaling is determined by the price of the bars and basically the size of the chart, the differences from one closing price to the next. So in order to get that scaling the exact same across all the charts and all the time frames, I have elected to add in what's called a z-score, and that will that'll yield the scaling in standard deviations above and below the mean. All right, so I can add any oscillator into this z-score with a look back of, say, 500 bars and kind of take an unbounded oscillator and apply overbought and oversold levels to it, essentially. And then we also get a chance to see those, 6 sigma moves in momentum. As this is still an unbounded oscillator, momentum, there's not a fixed, 100 upper bounds and 0 lower bounds. It can go as high or as low as it wants. But now that it's in standard deviations, when we get those really strong momentum moves, let's say above 6 standard deviations, we can easily see those, and they stand out on the chart, and you can, maybe you want to set alerts for when some market is in a 6 sigma momentum move and you're a momentum trader. So that's one of the things that I've added to be able to, basically to be able to do as many different types of analysis as you can possibly think of, all with the same tool. Okay, so that's just a little side note there as to why this scaling is bounded like it is, why we have overbought and oversold levels on a momentum indicator. That's typically not standard. Okay, and so here I went ahead and added in the double and triple to the bullish hidden to double regular divergence. So it's kind of a long name, but essentially we have a failed bullish, a failed hidden divergence, followed by a bullish regular divergence, and then one more bullish regular divergence, which is the double. Okay, and it'll basically treat the double and the triple the same way. It'll give the same, it'll set the bar to the same number in the data series to be able to access these signals inside a bloodhound. Okay, so it'll be the double and or triple regular divergence. You'll notice that we are able to get more than one type of divergence on any given n bar. Okay, I did that. I made that allowed because now that we're actually solving for divergence in real time with every incoming tick, not with every incoming tick. I mean, we have some kind of throttling mechanisms in there to only allow calculations on certain events to keep it from bogging Ninja down. But now that we're allowing the real-time calculation, you can get a signal and then it'll cancel in real time and then not allow the previous signal. So we wanted to be able to allow, as many different divergences as possible for any n bar, because, maybe in building a system for yourself in Bloodhound or whatnot, you may want to require that there be 2 different types of divergence on the same bar, just to kind of filter that down and maybe not get as many signals, but ensure a high quality type of signal. All right, so here, just give me 1 second. Sorry, got a bit of a sore throat. All right, this is kind of a mess, right? This is with every single feature in the software on, And I just want to discuss some of these because there really are just a huge amount of properties and filters and parameters and all of that. So here you see multiple different swing highs and lows. All right, just starting at the low here, it's a lower low, and it's a big square. That means that it's a major low. What I've done is I've divided up the swings into three different types of swings. Okay, there are minor, intermediate, and major swings. Okay, so each one of these swings operates independently. I added this into the divergence algorithm because just using a simple swing algorithm that requires, X number of bars, a break of the high of the past X number of bars or a break of the low of the past X number of bars, and requiring the same kind of distance and size for each move, regardless of whether you're in a downtrend or an uptrend or looking for pullbacks in an uptrend or pullbacks in a downtrend. I wanted to be able to allow different conditions for different types of moves. So I split them up into three: minor, intermediate, and major, requiring different conditions for each one, and they all work independently. So it doesn't work like a zigzag. All that to say, this allows us to find swing highs and lows that maybe wouldn't necessarily be found by other swing algorithms. So this is about as accurate as we could possibly get with finding the swings. Okay, and you can turn on the tick size. How far has it moved from the previous major swing low to the next major high? Well, that was 87 ticks. You could display that in ATRs or ticks. We have the different conformations of the swings, and then we have multiple different filters. So this is one filter. You see the 1.89 on that trend line? You can put a max on the distance, vertical distance, from one swing to the next. So let's say this swing high were way up here, and it ended up being over 5 ATRs. If you had a max of 4 ATRs set, then that would be disallowed. Okay, so that's just one of the many filters that we have. And what we've also added here is the trend of the major and the intermediate swing. Okay, so if we're making a series of higher highs and lows in the major, this will be up in green or blue. If we're making lower lows in the intermediate, it'll be down. So just a quick trend reference there. And we've also added the ability to control all of these features, all of the visual features, from within this little pop-out window right here. All you do is you right-click where it says Div Pro, and this pops out. You can turn on or off the swings. You could turn everything off except for the trend lines, connecting the highs or lows. You can turn off, the labels, everything. You can turn on the broken swings or only the active swings. Right now, all we have are the active swings. You're no longer seeing all of the broken swings that we had here. Now we're just seeing the active swings, and it tells you how far price is from those swing highs or lows. And if this is closed and you just left click on that button, it will cycle through whether you have just the trend line showing on the sub panel, or both the price panel and the sub panel, or one or the other. So you can really fully customize this thing to look exactly like you want it. And to show you how each of these are accessible within Bloodhound, I want to kind of explain this along the way. So whenever you're building any type of a signal out, you probably heard me say this a number of times, but you always think in terms of kind of the setup conditions. What are the requirements for beginning to start looking for the signal? So basically, what are all the requirements for the bar that I can essentially just, let's say, turn on the look for the next trigger? That was kind of a weird way of saying it, but basically think in terms of a setup where we will allow a trigger starting from these bars and then the actual trigger conditions themselves. Okay, so the setup is essentially when do we begin looking, and then the trigger is the confirmation set of conditions for the setup. Kind of a convoluted way of saying that, but essentially when we have a setup for divergence, that's the potential. So at that time, for instance, right here at this bar, if we were looking back, this prior swing is down about right here. Okay, so as these three bars were building, we had a dashed trend line there, but then the oscillator broke below the prior low, and this was canceled. Okay, here at these three dots, you see little circles, that's marking the setup. You can turn that on or off, but on this bar, we make a lower low to this low. So we're looking from this low back to this low. We're making a slightly lower low. So in real time, there would be a dashed trend line there. And okay, well, it didn't turn up far enough to trigger the trigger arrow. So it comes down a little bit more. Well, now we have, again, a divergence setup. The oscillator is still remaining pretty significantly far above the prior swing low. And then we go sideways a little bit, and then we get the trigger condition. And this divergence is now confirmed. Okay, does that make sense? So that's kind of the way you have to build out a type of pattern recognition thing like this. You identify the bars as kind of the potential, and then once it moves far enough back in the opposite direction, then that confirms the setup. Okay, so these are the signals for the setup, which will be found in real time as the bar is building. And then these are the triggers, and there are multiple different triggers. I'm not going to go into all of that. We don't really have time. But we have 6 different triggers and a number of different possible conditions you can add on there. One is actually a fib retracement trigger, which would look at the distance between the two trend lines. So let's say from the lowest low back to the highest high between the two lows. So we would look from basically a Fibonacci retracement of this high to this low, and then you could set that percentage retracement to any amount, let's say 30%, 50%, or even 100%, and not get the trigger until we break above that prior high. So we could actually get the trigger in real time as that high is ticked out, or whatever fib level is ticked out. Okay, so 3 of those triggers are in real time. They'll fire as the bar is building, and then 3 will require that the bar close. And you can actually make the real-time triggers fire at the close of the bar as well. So full customization with this. It's pretty incredible what all you can choose from. One little caveat as I say that, let me just show you something so it's not expected to be overwhelming. Okay, what I've done in this version, I've added in a lot of different presets. And let me just kind of open this up a little bit. So this is what's so amazing about what we've done here. The ability to now use this little pop-out user interface to switch between another instrument or an oscillator. And this will access every single available indicator that you have in Ninja. You can put it on any custom DLL, you know, whatever indicator you get from anybody. And then it will auto-populate the properties here, just like Bloodhound does. And then you set it up accordingly. Now, what might seem overwhelming to some people would be the fact that you have all of these different properties. You have all the different, we've kind of grouped them together so it's a lot easier now, but you have all the regular divergence parameters and filters, and it's a pretty large number, and it's a lot to have to learn, but each one is really well documented down here. So And there's going to be a massive user guide. We're just about done with that, actually. And it's pretty massive. And then we have a number of other courses, too, that we're building out here. So we have a lot of other courses explaining this stuff. And those will be done. Those will be available shortly. But what I wanted to show you was, let's say this is a little bit overwhelming for you. It's kind of a steep learning curve. Well, really it's not, because what you can do, depending on the oscillator or the instrument that you've selected, you can choose from a number of presets. And that is the second property here. So if you click on that, you'll see all of these different presets. You can select other instrument if you have another instrument as the source. For the balanced momentum, I have a balanced momentum preset, and you saw some properties collapse. Now there's some hidden. Only the ones pertinent to the balanced momentum are showing. Let's say that I change from looking at both regular and hidden divergence, which you see right here, hidden divergence parameters and filters, regular divergence parameters and filters. If I just want to look at regular, well, then all of the hidden divergence parameters are now gone. They totally disappear. So we've completely streamlined the user experience. We've made it a lot more intuitive and easier to use, and you can choose from any number of different presets here. For the default oscillator will load into a z-score, so you don't have to change any of the settings per the market or the time frame that you're looking at. Balanced momentum loads into a z-score, and then you have this CCI, the DTI, normalized MACD, the RSI, stochastics, and the TSI. So those are about the main oscillators that most people use. You may use a derivative oscillator. You could use the TSI setting for that, and then just change a couple of thresholds. So the addition of that has made this much, much easier to use. So I just wanted to kind of show you that as we're going through these, all these different settings. It can be a little overwhelming, let's say. Somebody's saying, did we lose audio? You guys still hear me, right? I'm going to assume so. Yeah, good. Okay, cool. All right, so I added in a ton of different data series in this version. So before, we just had the data series for the setups and the triggers. Now we have the data series for all the setups and the triggers as well. That rather than having, if you want to access the single regular divergence or the double or the triple, you had to use one data series for each of those. Now you can say, give me any regular divergence in one data series, so that you have one solver for absolutely any regular divergence. You would get them for the single, for the double, and even for the triple. So it's just a lot. We basically wanted to make this as easy to use as possible. So that's what we've done, and then we've added some data series in for the trend direction, the trend conditions as well, and then also for all of the independent swings, not associated with the divergence, but just any swing low or swing high, if you want to be able to access the conditions that create this swing finder. And it's probably one of the more accurate ones. It's a pretty interesting little algorithm. That was actually one of the hardest things to this, to be honest, designing that swing algorithm. So that's the intermediate swing. Did I already show you the major? Yeah, those are the major conformations, the black, larger swings, and then these are the intermediate. The minor swings are simply for confirming the intermediate. Okay, and then the intermediate swings confirm the majors. So it's a pretty interesting sequence of events that creates these swings. This is the major swing trend, intermediate swing trend in Bloodhound, and of course I'm accessing all of this stuff in Bloodhound without having to run any of the divergence calculations in Bloodhound whatsoever. I'm not running any calculations in Bloodhound. All I'm doing is I'm accessing the available data from the Divergences Pro, from this chart, in what we've just called a reader indicator. That's essentially just telling us whether it's a 1 or a 0 or a 2 or a -2 or whatever for that given bar. And we can read any chart, any time frame from any workspace, from any other instrument onto any instance of Bloodhound. So pretty endless what you could design and test and figure out for your next system. All right, so these are some of the different things that we can do with, now that we have the ability to add in another secondary data series, an instrument series, into the into the Divergences Pro. We could compare. This is just one kind of wild example, but maybe not so wild. It's actually pretty incredible. I was going through and comparing. I worked with intermarket analysis when I was probably in my 3rd year. It was actually right before I left Ecuador. I started, I read the book on intermarket analysis. What's his name? Murray or something. Anyway, pretty interesting stuff. And then one of the most famous automated systems, I can't remember the name of it, John Murphy, that's it. But there was a system that you could lease, and it was pretty famous. A lot of people talked about it for a while, a couple of years ago. I can't remember the name of it, but anyway, they lease it, and it's built on this type of a intermarket analysis type of thing. So now we can do this in the Divergences Pro. You could compare the 6E to the 6B. I found that typically, they're going to line up better if you do it this way, but if you're using 4X, you want the first instrument or the second to line. So for instance, if we're looking at the Euro USD, whatever else you want to compare with the Euro USD, you would want the second part of that to be USD. So Euro USD with British Pound USD or Australian Dollar USD. So that's kind of one of the things that I found. If you do the opposite of that, then you have the markets moving in completely opposite directions most of the time. So they're kind of reversely correlated, which doesn't seem to work as well with this type of analysis. So anyway, this is a major swing high in the euro, and you see in the pound we were already heading down pretty strong, so suggesting that much more likely for this to be a major swing high than to keep going to new highs, as we've already been incredibly weak in the pound. So these are the types of things that you can do. Now this is just one example where I've combined a 2-minute of the euro, a 5-minute of the euro. These are the confirming charts, the 2 and the 5, with an hourly chart of the euro, and then that same 120-minute euro chart with the British pound as the input for the Divergences Pro. So that same exact example that I just showed you here is right here, is this chart. Okay, so I've waited for that big divergence in the 120-minute chart. I'm confirming that with a double divergence on the hourly chart right here. And then, we get that divergence in the hour, that double divergence in the hourly chart, and this divergence as all of this is building. So we're probably, I think it's somewhere right around in here, it's on that bar exactly, that we begin getting the setup for the 120-minute chart and the hourly chart on that bar. So how do you know when to take that signal then? Well, for me, I would at least wait for waning momentum on the faster charts. So I want to see a sign of weakness, and then one more attack at the high, preferably not going too far above this prior swing high, which is one of the reasons that I added in that other filter that I was showing you with the maximum distance between the swings, and then confirm that divergence and then initiate the trade. So this is just one example of how you may be able to use this type of a thing in intermarket analysis. Now, we could go through and do all kinds of examples of this, but what I'm showing you here is the reader indicator, what I'm doing is I'm accessing all of those different charts, not by bringing those charts, those time frames into Bloodhound and building those inside of Bloodhound. No, all I'm doing is I'm accessing the signals generated on that chart itself through a secondary data, through a secondary indicator that accesses the data series of the Divergences Pro. Okay, and that's that reader indicator, and that makes loading something like this, which if you've worked with some very heavy algorithms inside of Bloodhound or just in Ninja in general, it can take a little while to load. You know, you're sitting there for 15, 20, 30 seconds sometimes trying to load something like this, whereas this loads in less than a second. So there's no strain on Ninja with this. So it's really, really nice. Especially when you're trying to design something, it just makes working in Bloodhound so much faster. And this is just a hint at some of the different data series that you have. This is the one I was telling you about. You can access any regular divergence rather than having them all split up. And this is how you load the reader. You can do any chart from any workspace or just the charts from the current workspace to make it easier to find. And then you select the chart from a drop-down list. And that's how you use the reader in Bloodhound. I'll show you some examples of that on Saturday in action. This is comparing just the euro pound with the euro USD. You see how I have the euro and the euro at the beginning, and then the British pound at the end, USD at the end. So they tend to kind of move in sync when they're more correlated. And then when you start getting that divergence is where you want to kind of pay attention as to what's going on. So at this high right here, we've moved up higher than the prior high. This is kind of a weird top in here between the two. We've moved up higher than the prior one in the euro USD, but in the euro pound, we're actually lower. And then we put in that hidden to regular divergence right there, and then we come on down. So this one is showing you that it's in a weaker position. Okay, so this is how I would look at something like this. And there's a couple of different ways to look at it, and both arguments make logical sense. Obviously, you would have to test it out and run a number of back tests and whatnot. But the way that I trade is I wait for a break typically, not all the time, but you know, sometimes I have to trade a lower high or a higher low if I've missed the major reversal. But typically I'm gonna wait for a break of a prior swing high to get short, or a break of a prior swing low to get long. So as far as how I would look at this, I would much prefer to short the euro pound on a break of this prior high right here, with the euro USD just kind of confirming that, saying that, you know, the euro USD is actually in a weaker position. So the fact that this could be a high, you know, slightly more probable. Okay, so that's how I would look at that. But now we can compare these two together, and this is where it gets a little tricky. And this is the major high right in the middle of 2000 and no, right at the end of 2008. Yeah, right at the end of 2008. Everybody remembers this, right? For at least you guys that have been doing this for a while. When we had all the markets moving in the same direction, everything was going down, 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 deflation, deflation, deflation. So at this high, in the Aussie US dollar, we had pretty serious, it's just a, to me that looks like a perfect swing high. It's a nice wedge, it's kind of coiling into the high. It's like an ending diagonal, really, kind of. But here, in the pound US dollar, we're already starting to come down. Okay, so do you trade, do you short then at that major high? And that was a pretty major high across most markets. Do you short the pound dollar or do you short the Aussie dollar? Well, if you shorted the pound, you made about twice as many ticks because it's a much higher price. But as far as the percentage amount in the Australian dollar versus the American dollar went much further down. But, you know, tick for tick, you would have made, I think, almost twice as much. This was like $6,700, and this was about, I think it was like $3,800 or $3,700 with one lot, dollar per tick. So, yeah, right. So comparing markets and comparing relative strength and stuff like that. So the exact opposite here, where now we're making a lower low in the pound, but the Aussie dollar is making a higher low. So it has some really incredible signals just looking back on even on weekly and daily charts. And this is just one. I'm just trying to give you as many examples from as many different markets as I can right now. But this is a daily chart of the NYSE, so the big index with the tick. All right, so tick index it's basically looking at the upticks minus it's looking at the number of stocks basically moving up versus moving down, uptick versus downtick kind of a thing. So the advanced decline line is a little bit different than that. I'm not going to get into all of that. Basically, traders will, for the U.S. equities, especially because you have three, I think, or you have four. You have the tick, which is for the NYSE. You have the tick Q, which is for the NASDAQ. And then you have the tick DJ, which is for the Dow Jones Industrial Average. So I would tend to favor this NYSE tick for trading the ES. And then for the NASDAQ, you use the associated tick Q, which is from the NASDAQ index. But just to get a kind of an idea as to what's going on internally, they call these market internals. You're looking at the internal state of the aggregated instruments within that instrument. Of all the instruments within that instrument, you're looking at how many are moving up versus how many are moving down. You can compare up volume to down volume. There's a lot of different market internals that you can use, and I'll show you some examples on Saturday, but it's pretty interesting stuff. So this is your major swing low in the NASDAQ before the end of the year last year. And tick was gradually getting less and less. So there were more markets starting to end that little downtrend that we had here and start turning back up than there were markets continuing that down move. So that's just a really nice, clean looking swing low, as it was on pretty much every equities market. All right, now this is looking in a little bit closer on a 1 minute chart. And this was the current day when I did this. I think this was on the 23rd. So when I took this example, this was the day. This was the data that I had in front of me. So I just snapshotted it, and you had the high of the afternoon, you had the low before the close, and you had the low of the day on a double divergence here. Pretty interesting. This is, again, looking at the ES with the tick. This was today, just before coming on the air. I just wanted to do a snapshot of what was in front of me. And both hidden and regular divergence. We see the low yesterday was hidden divergence. You had a couple of nice little swing highs where you had, if you can see this, you see the exact bar that you had the high on was the first bar that you began getting the setup. So basically, right when that line started plotting, the high was made. Right when this line started plotting, that little high was made. And the moment this little line started plotting, that high was made. And likewise, you see the setup right there on that end bar. Right as that line began plotting, that low was made, and then it turned up. So the same thing right here. Look, you had one right here that didn't complete, but that was a pretty large, wide-ranging bar. I know this is probably hard for you to see, but then again here, this little tiny dot there, that's telling you the bar that began the setup, and right as you get that setup, the high is made, and then it comes on down. You had the setup on the big down bar right here, and then the next one, which is what, just a tick lower, 2 ticks lower, put in that little tiny swing low, and then this one actually came down. You had the setup for about 4 or 5, 4 3-minute bars in a row. All right, so that's just one day. That's today. And then this is the NASDAQ with a tick Q. All right, I don't think we have too much more time. I'm going to go for about another 10 minutes, I guess. And then I'll let Jeremy and them call it a day, and then we'll pick up Saturday, and I'll get into a lot more examples. What I do want to do before I go is briefly just cover a couple of, let's cover at least one major reversal that we had in crude oil, and I'll show you a little about how I deal with that. So this is the YM. This is the Dow Jones Industrial Average. This is showing you the little swing high here, swing high there, swing low here, as that one was made. Tiny little swing high right as it was being made. This one failed. That was a nice little swing low, perfect swing high, nice little swing low. This one plotted right on the low, but then the next bar it failed. And then this was a nice little swing low before the close. Pretty interesting stuff. This is looking at sector analysis. Let's just kind of slide through this real quick. This is comparing Goldman Sachs to the XLF ETF. Jeremy, do you mind if I go maybe 15 or 20 minutes more? Just curious what your...
No problem at all, Daniel.
All right, cool. Thanks. So here you can see the white line. I wanted to show at least one example of that fib retracement trigger, because that was a pretty difficult thing to accomplish. I don't know why it was so difficult, but as those triggers are in real time, the second net value in price is transgressed. The second you break above it, you're going to get that arrow, that trigger to fire. And you can set that at whatever percentage that you want. The reason why it's so far up here is because we're looking at the highest high between the two lows that are connected. So if this low and this low are connected, it's looking at the highest high between them, which is right here. So it's essentially drawing a fib retracement from high to low, and then it's set to whatever percentage value that you want to set it to. And it will use that line as the trigger. So anyway, you have a double divergence here for the low in Goldman Sachs before this massive uptrend that we've had, which is looking like the fifth wave. And this is the financials ETF right there. This is Bank of America with the financial ETF, major low on divergence, and then just showing you all the other hidden divergences. Just showing you how you can do sector analysis with this now, comparing different stocks with their ETFs, or even different stocks within an ETF together. So we could compare, you know, Conoco with Exxon or anything like that. So we had a major low here. This is ConocoPhillips with the energy ETF. And then here we had a double divergence low. My throat is feeling pretty rough, but isn't that beautiful though? Just a beautiful double divergence there between the stock and its index. And I was looking at this, and you can get a readout of, that's one thing I forgot. I was going to show you this, but you can get a readout of all of the ETFs and the weights of the different stocks in there. Josh, I don't know if this is even necessary, but if you're interested, Josh, could you put the link to where you found that in the chat box if you're listening? It's pretty cool. You can get a readout of the different weights for all the different stocks in each ETF. And I found that you don't want to use the stocks that have the higher weighting. So the ones that have the 4 and 5 and 6% weights. Some of them even have 15%, which is, I don't see the point of having an index when you weight it like that. But they tend to overweight the larger ones. And, I know the reasoning behind that, market share and blah, 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 but obviously you don't want to compare an instrument to an index, which is made up of 15% of that same instrument. So it's interesting to do this, though. I've been working with this for the past couple of weeks, and obviously you want to retain a fairly high degree of correlation, and there's a good indicator for that on futures.io, Big Mike Trading. They have a free correlation indicator. So you want to, have a positive correlation, but you don't want it to be too close either. And then you'll start to see these diverging signs of strength and weakness compared to different stocks and sectors, and it's pretty cool stuff. So this now, how I trade, this is the major high that we had recently in crude oil. Let's do this. Let's go over this. The way that I put everything together, I put everything together with market geometry. So major swing highs and lows, I don't know why this is the way that it is, but is it something inherent to the way that the market operates, or is it because so many people use it? The oldest chart that I saw that had trend channels on it was from the late 1800s. So people have been using this stuff for a very long time. And watch how this swing high comes in based on this major swing low, this major swing low, and this major swing high. Every future area of supply and demand is a function of the previous areas, not the previous areas themselves. So not that this exact price in the future is going to be resistance. It's a combination of the areas in this kind of geometric patterns. And this high comes in perfectly right there with bearish divergence, obviously, on the 240-minute chart. So I'll talk about that in a second. But here you have the confirmation that I'm looking for, which is an incredibly high volume per range. That's density there. And this is relative density. So we're looking at just a different way of looking at volume. This presentation obviously isn't about fully the way that I trade or the relative volume. We're focusing on the divergence, but this is obviously a strong reason for this making an important high right here. Okay, so as we zoom in on this a little bit, you can see it a little better. We have waning momentum on the big chart, so this is the 240-minute chart. So really, it looks like we're in a major uptrend across all the different charts. And technically, I guess you could say that we are, but we're still below this major swing high. And this is using non-back adjusted prices. So these are the true traded prices. And I think it's even lower actually in the back adjusted prices. But anyway, all of this is completely nasty and overlapping. This is like two sets of corrections. We have a correction up here, X wave, and then another correction up here. So it's like a WXY, maybe even a 333. But anyway, coming in perfectly right there on divergence on the larger chart. So if we have divergence on the larger chart, then you don't always necessarily get divergence on the faster confirming charts. You do want to wait for it, at least on the 20-minute or the 5-minute. But at the final swing high, you may not necessarily get that confirming divergence. And these are the things that we're going to talk about on Saturday is how I combine all of the time frames together to confirm whether we're going to have an important swing high or not. You know, where that is likely to occur, what it's typically going to look like, and how to prepare for it. So you wouldn't say that I trade mechanically or that I have a kind of reactionary system. Basically, everything that I'm doing is in anticipation of a major swing high or low. So I'm trying to find where that next area for the major high or low is going to be, and then yeah, sorry, just if you can't see the questions, I think you have to click on the little plus where it says questions, and then click on that plus, and then I think it drops down. So anyway, here on the 20-minute chart, this is a Bloodhound template that I built out for this specific pattern. This is a volume divergence pattern that I look for. We have one here at this high, but it only works with a relative volume. It doesn't work with a true volume, not on such a large chart as the 20-minute. But here you have the same thing: climactic, swing low, massive volume, slightly lower low, less volume, confirmed by the divergence. This one, yeah, you had divergence there, but it's kind of broken by that little, this is kind of a strange indicator anyway. This is the SMI, just something I was testing. But anyway, here you have the same thing. You have volume divergence. You have a massive, very high momentum move, very high volume, and then what do we have? Sign of weakness right there. And then we go back up and break that high. And where do we stop? We stop right at the area number 1, and then area number 2. All right, so we have 2 areas coming together there already. I'm not going to show you the areas in the daily and all of that. Actually, maybe I am. Let's see. No, okay, so this is the 5-minute. And so first of all, we had divergence on the 20-minute. And now we have divergence on the 5-minute as well. It's the same 2 swings, but even still with, you know, a larger number of bars between them, we still have bearish divergence there. And this is using the 310 oscillator. It's like a MACD made out of SMAs, just a faster MACD. So yeah, very strong swing high. And then even more areas coming together. So we have a confluence of all the areas in the market geometry. We have the volume divergence on the 20-minute. We have divergence on the 240. We have divergence on the 20. Now we have divergence on the 5. And we have a buy-in climax right at the open, which is incredibly hard to trade, obviously, because it just shoots straight up and then straight down, and then it kind of drags back. So let's say you miss this. Well, let's look how it looks on the tick charts too, though. Once we finish this example, then we'll call it a day. Clint, do you have the link for Saturday's webinar yet? Would you put that in Skype for me, please? So here, yeah, you got it. The same spot now on a tick chart. So we use both tick and minute charts because the areas are a little bit different across, you know, minute and tick. But look at just the divergent signals here, just on this one chart. Major low here, major high here, major low there, retracement low there anyway. And then major high here, very high volume per second. 2 climax bars into the high. And another set of areas. Here we have what's called the warning line of this channel. So this channel here, low to low to this high. We take the size of that channel, add it to the top. So that's like a moving 1-to-1. It's like a moving 100% expansion of the width of this channel. And see, that's why I think, I mean, this is, I sometimes sit and think about why this stuff is the way that it is, but I think it's because we're combining time and price. It's like a moving area. And you see this stuff work enough, it kind of gets a little mysterious. It's kind of strange, really. But anyway, on the faster one, on the 440, now another channel coming to the top of that right at the open. And you can see the double divergence we had here at the low. So we don't actually get divergence on the faster charts. It's just a straight shot move, which is actually why I missed that high. We were talking about it. Should I short it? Should I short it? And then it opened, and you have about 2 seconds to short it, and then it's already retraced, you know, so much that the risk on it would be another extra 10 or 15 ticks. So actually ended up missing that one after going over it for hours, but waiting for it. Anyway, here on the 2-minute, which is typically the confirmation chart, it's just a straight shot move into that high, but it's incredibly high momentum. All right, we're well above the 3rd standard deviation now. It's almost to the 4th at that high, and in real time, it hit 5 or 6 on this bar. So anyway, you see the buying climax, the sell-off, and now it's kind of retracing back up, and that was your last chance to get short right there. And look at that, one last little channel. Huh, interesting. All right, well, let's say you missed that and you want to get in on the lower high, and we'll finish with this little set right here. So how do you do that? Well, I'm not going to have divergence there on any of my higher time frames, but I typically will use a faster chart, sometimes faster than my normal confirmation charts, to confirm the retracement swing high. And you typically want a faster tick chart to do that. Maybe a 1 minute, but most of the time you'll need a tick chart to find the end of that. But in this case, it showed up on the main tick chart that I typically use for confirmation anyhow. But here I'm connecting the 2 highs back to the low before the high. This is a very important low. A lot of people kind of neglect this, but the low before the high or the high before the low, even though it seems small, that's an important area. It's the last area where the major demand came in. Connect those two together. The upper median line is right there, or whatever you want to call it, the pitchfork. And then this little line here is what we call the kiss goodbye line. So this is our last uptrend. And you see it's a waning uptrend. It was stronger, more vertical. Now it's almost sideways. We break out of that, and then we pull back to it, right at the 78.6 retracement. And that's the 2-minute. And then on the 5-minute, you see the same thing. We break out of that channel, pull back to it, and we get our little buying climax followed by a churn bar, very high momentum. We get a huge spike in volume per second. We get a hidden divergence. Again, it pulls back to the same channel that we broke out of. Pulls back to it. That's why we call it a kiss goodbye. You're in a channel, you break out of it, you pull back to it, kiss goodbye, and then go. And then here, finally, we get our little divergence signal right at the area, and then boom. And that was your last chance to get that 140 tick move right down to the next area in the market geometry. One, connect the high to the high here. This low is found automatically with our little toolbar that we have. And then, just to show you that I kind of teased you with this, but this is what we use for the market geometry. It's not as sophisticated as Jeremy's Bloodhound, but it's a pretty amazing piece of work there. Why can't I grab this? Sorry. Okay. So it came right down to the predefined area in the market geometry, straight shot down to it. You had to hold through an overnight pullback, but of course if you were short and you were holding overnight, that wouldn't have bothered you anyway. And then boom. And then now at this low, how are you going to get out? When are you going to get out? Well, of course you're going to wait for the area, but what do you expect it would look like at that area in order to confirm that. Here, you have the similar kind of look that you have here, but you're not at any area right there. Some people obviously got out of the trade there, and some actually sold the previous break of that low, which ended up being a winning trade actually, but they had to take some heat right here. So a lot of people, got in and out right there on that bar, as noted by the high volume, and then the next bar was very high volume per range, so a lot of fighting and supply and demand right there, and then it knocks it sideways. And then we come on down now, incredibly high momentum, down to -4 standard deviations, and then sideways, and then a pop lower, and a lot of yellow in here. A lot of yellow means if you're at a low demand, if you're at a high supply. And then that was the major low, right on a tick or two of a break. I think it was almost to the tick on that area. And then that's the perfect look for our swing high there. Our swing low to exit that. It's crazy, isn't it? So anyway, this divergence is one of the main things that we use to confirm these areas, and to confirm on the faster time frames when to enter the trade, and of course when to exit the trade. And on Saturday, I typically don't look at such a fast tick chart. I'm just glancing over onto one of my computer screens. This is currently what's happening in crude oil. And I mean, it's just nonstop. Major low here, major high there. This one failed, yeah. Triple divergence didn't fail. And then another divergence there. Double divergence low here. And now, of course, it's closed. But so we'll go through day by day over the past 10 days or so on Saturday, just so you can kind of see, how useful this stuff is. For one thing, I spent so long going over methods and using tools that were, unfortunately I had no idea because I didn't have the proper mindset. I believed what people told me. And the salesman said that it was a good system, so I bought it and I traded it, and I thought it was a good system because that's what everybody told me. But looking back on it now, it's like, how can you be so foolish? But this is kind of a different industry, isn't it? You don't really know, you don't know how to deal with just how people market and stuff like that if you're not used to it, you're not exposed to it. And there's just so many things out there that people sell that, everybody wants a quick, basically you want a shortcut. I want a shortcut. I want to be able to throw something on the chart and get a signal and say, okay, well, buy now, Daniel, and you'll make 100 ticks. But obviously that sort of thing just doesn't exist, does it? I mean, if it did, fully mechanized, number one, and this is, I can argue it, but I can also prove it, the majority of all the very successful CTAs are discretionary traders. Now, there are some very successful mechanical traders as well, and they do have pretty high returns as well. But we're talking, I think it's like 15% to 85%. So obviously there's a lot to wanting to mechanize everything, and I do too, and we are mechanizing as much as we can because it makes the decision process that much easier, which is why Bloodhound and Blackbird are so important to the things that we're doing, because it is kind of an intensive type of analysis that we're doing. But I don't know of anything else that is even as close as, as good at finding major turning points as with the methods that we're using. And like I was saying, I mean, I know everybody wants a shortcut to trading success, but if you find one, let me know. It's a lot of work, and You have to get that brain thinking statistically. You've got to be able to, I think, it's, if nothing else, it's an excellent exercise to just build out some of the typical stocks and commodities magazines automated systems with your typical moving average crossover or stochastic, bias stochastic break of the 20% line when you're above a 200-day moving average. Something like that, and then back test it, setting proper parameters for your exits and your targets and all of that, and get a feel for those numbers and try to make improvements. And just working through that time after time after time, you start to realize that, hey, this is a lot more difficult than I expected. I thought I would just be able to take these rules that I have created. I was always told, if you'll just stick to the rules, the system works. You're just not doing it right because you're not following the rules. And that may have been true, but that's kind of human nature. We tend to make mistakes, and especially in trading, right? So I thought, well, if I could just mechanize all those rules, then it's a winning system. It has to be. I paid $10,000 for it. And then you program it out, and you start to realize that, hey, this is not even nearly as easy as you thought it was going to be. So I don't know why I'm saying that. I guess I'm saying that to say that anything that I'm talking about or showing you or developing for my own use, and it is all for my own use. I'm just selling it secondarily so I can support myself and pay for it, are things that I've proven out. Yes, it was in Sim. I did prove it out in Sim, but now I'm proving it out in a live account. And yeah, it's a small account, but nearly 200% in just a few months is pretty good. So if that continues, then I'll have a pretty amazing track record. So I wanted to do that live account, and I wanted to do it in front of people, which is 10 times harder, just to show that I got some skin in the game, and I believe in this stuff, and I know it works, and I haven't been below $5,000, and I've just been steadily increasing. So all of that to say it is possible. It's a lot of work, but for me it's fun work. I love it. Let me just answer a couple of questions, Jeremy. Are there any that stand out?
We just got a couple people asking for a link to purchase there, and a link for Saturday for your Saturday webinar. I'm assuming you're probably going to send that out to all the registrants. Is that right?
Yeah, I'll send it out. I put it in Skype. It's not letting me post in GoToWebinar. I don't know why. I put it in Skype to you.
Okay.
The purchase page, and then the sign-up page. Yeah, NT8 will be, I'm thinking, probably another 2 months. Maybe not quite that long. I say 2 months, but I don't know how difficult it's going to be to port it over. The volume stuff will be over pretty quickly, but Divergence might take a little longer. I don't know. Yeah, it's part of the Master Suite. It's a free update for you guys that have already purchased. It's a pretty awesome free update. Yeah, we're creating all kinds of... well, we're doing the user guide first, which should be done 3 or 4 days. I'm probably just going to send out the first section of it, the getting started version, tomorrow, so that you guys have that. So you can, mess around with it, get used to it tomorrow, and then on Saturday we'll go into, quite a bit more detail. Basically, just go over as many setups as we can in as much time as we have.
Okay, folks. I just to let you know, I've put both the links for the launch. Which is tradeaplan.com/divergencepro4-launch, and the webinar registration for the event this Saturday, which will also be emailed out to all you guys as well.
And if we didn't get to your question, just send in an email to support@tradeaplan.com. Yeah, we'll record the. Well, he's already left, but yeah, we'll record Saturdays. Saturday will be more like a training session. Showing you how to use it and how I use it and how it performed over the past week or 10 days or so. So that's it, guys. I think we'll stop there, and thank you so much for coming, and look forward to seeing you, talking to you on Saturday. And like we said, we'll send out a recording and the link to join us Saturday. If nothing else, you'll gain a lot better insight into kind of how the market moves. I think people have a difficult time analyzing multiple time frames, and when you see somebody go through it a few times, I think it'll start to click for you. I think after Saturday, if you've had a hard time with analyzing, more than just a couple of charts at the same time, should start to click for you. So, all right. Thanks, Jeremy. Thank you, guys.
All right, you're welcome, and thanks, Daniel, for the presentation. By judging by the comments there, a lot of people enjoyed it and got a lot out of it. It's very typical. Whenever I see Daniel present, there's always a tremendous amount of support you guys have. So I just want to remind everybody that this was recorded, and you should receive a link probably tomorrow with the recording if you'd like to see that. But I also highly recommend you attend this Saturday where Daniel's essentially going to be giving you a free tutorial here of a lot more stuff in depth than what we saw today. So definitely don't miss out on that.
Yeah, we're going to go into using the reader in Bloodhound instead of having to load all the time frames into Bloodhound, just loading different solvers, accessing those different time frames. So we'll go into that on Saturday as well. All
okay,
right.
Awesome. All right, thanks everybody. And any last words you want to say there, Daniel? Or you all good?
I'm good. I enjoyed working with you guys. I really appreciate you guys at Bloodhound, Shark Indicators, for doing these things for me. It's been a wonderful relationship, and I just really want to thank you. So if it hadn't have been for using Bloodhound, I don't think I would have made it as far as I have. It's really been through using Bloodhound that I was able to kind of put aside all the stuff that I thought worked and just focus on those things that I could actually prove out. And Bloodhound, makes you do that, makes you prove things out or get rid of it. And I had to get rid of a lot of stuff, but it's been well worth it. So just want to say thanks.
Yeah, it's always appreciated. No, thanks a lot for the compliment. It means a lot, actually, especially having a trader of your caliber, say something like that. So myself and I know the rest of the team, we work pretty hard on our tools, and it's always good to see it put to good use here.
Oh, yeah, I can't thank you enough. So, all right, you guys, thanks for showing up. We'll talk to you again on Saturday. All right, thanks, Jeremy.
Bye. Yep.
Bye, everyone.